Hey everyone, how's it going? We just got the closing bell for Tuesday, August 13th. We were talking about how if we didn't reach the MA50 on the S&P 500 today, then we wouldn't be entirely confident that we could break above it tomorrow, even if we had a positive CPI report. So let's take a look at where we closed it. We were a little bit below it at least a few minutes ago. So we'll see where the actual close was on the SPY. SPY, yeah, we're still short of that MA50. We made good progress. We did definitively move above that EMA 20, and we are pretty close to that MA50, but we're just not quite there. We closed out 541.99. So basically we've got our MA50 at 543.74. So that's definitely within reach. We've got our ATR at 9.7. So that is well within reach of tomorrow's range. But will we get there? Will the CPI push us above it? It's possible. If we get a good CPI report like we did today, it's possible that we'll get above it, but I don't know about surging above it or going significantly above it. Right now, we need that major catalyst. CPI, I just am not sure if it's a strong enough of a catalyst. So for now, we're going to just wait and see how that CPI number prints and whether or not it's enough to get us to stay above that MA50. So let's see what else we can see. What we really want to see is it to break through and gather momentum. So it's got to be a conviction trade, sort of like what was on the screen before I changed it, BMY. BMY, very strong movement upwards and above the MA 200. So starting to get slightly positive in that. But BMY is, of course, part of the XLV sector, which was one of our strong sectors. And you can see this is a nice gentle sloping uptrend, came and bounced off the MA50, came above the EMA 20 and the EMA 8. We're getting separation from those two. This is looking like a nice healthy move. It just has to get above these highs and XLV could take off from here. So that's sort of the move that we want to see in the S&P 500. We want to see it break above those resistances with some conviction like we did on this day, continue. We have 2 full days above the EMA 20, and we'll consider that above the EMA 8 as well. Today is a third day with some strong momentum upwards, or we could say that this broke through and then came and retested that EMA and then moved upwards. That's very strong. So XLV is looking really good. So we would want to see a similar type of move on the SPY before we got too excited. So it would have to come up and break through that MA50 and then have the low above the MA50, maybe come back and retest, and then go and break above this 555 level. Then I would be a lot more confident that we could go bullish on the S&P 500. For now, we still want to stay on the somewhat neutral side, and we don't want to jump the gun unless you care to do a tail risk trade. So maybe if we have a little bit of time today, we'll take a look at a potential way of playing the tail risk. So QQQ, same thing, moved nice and smoothly above that EMA 20, but that distance between the EMA 20 and the MA 50 is the problem. It's very unlikely that we're going to be able to definitively breach that MA 50 tomorrow with a good CPI print. We might touch it, but then that acts as resistance. And then we're not nearly in the same situation as the SPY because to be definitively bullish, we've got to get above this 485 to 488 level before we could get confident with the QQQ. And then SMH, I'm going to use a different chart that's not all marked up. That SMH has to get above this quarterly VWAP, above this 247 and a half level, then this 265 level. It's got a lot more way to go before we can get too bullish on the SMH. So will the CPI print alone do that for SMH? I really don't think so. If we can't get SMH up, then we can't get QQQ up. But it does seem possible for the S&P 500 because of the other sectors, the sectors that are actually looking strong. So just as a reminder, we'll just take a quick look at those sectors right now and just see which ones look strong. Are they the same as the ones that we've been looking at the last few days? GLD came and paused at these highs right there. Actually, it's a good place to take some profits if we were in a GLD trade. So like I was from here all the way to here. So, well, I guess technically to here today. So that was a nice gain right there. Probably, if I remember correctly, it was over a 90% gain. So GLD, since it did have trouble topping out right there, and we do have a CPI report coming out, it's just good to take some risk off the table. The other sectors, what are sectors are looking good? XLU looking very strong. ITA defense looking very good. XLC not bad actually. XLC's it did break above that MA50. We did close above the MA50 2 days ago and then come back down and test the EMA20 and pop pretty definitively above that MA50. We just want to see if that low tomorrow can stay above that MA50, and we could be on our way upwards on the XLC. We do have a bit of resistance right there. Yes, at the 86.5-ish area. So we'll see if we can break above that. The other ones were XLV looking good, as we looked at that just a few minutes ago, but XLP also looking very good. You can see that this current level is above these highs over here. So this whole region that we're in right here is testing a new high. We're kind of flat right here, but we're right there. All it takes is a little bit of shove and we can get right above that and continue this upward movement. Our moving averages are all sloping upwards. We've got a perfect rainbow. We're getting separation between the moving averages. XLP is looking excellent, actually. So the sectors like these, like the XLPs, the XLUs, the XLVs, XLRE used to be one of those sectors. Yeah, XLRE, same, very similar situation as XLP. These highs right here, and we're right there. We can just easily break over. That's a perfect rainbow. We've got separation. These are kind of parallel on the shorter moving averages, but all it takes is a little bit of a move and we'll start to get even more separation from those again. So XLRE and XLP are in particular are looking really good. Those are major components of the S&P 500. So it is conceivable that our S&P could move upwards while the QQQ gets stopped out and then chopped sideways. That would limit the S&P's ability to just really fly upwards. And so if that happens, then what we're looking at is maybe matching an all-time high here, not really breaking out unless the QQQ stocks can then break out of their range and move upwards as well. So again, I don't think the CPI data is by itself enough of a catalyst to send us in that direction. So we'll see. Maybe we'll just get a little bit more choppy movement out of the S&P and QQQ, but it is looking more positive for the S&P 500, but still not looking so great for QQQ. So that just means that the upside would be limited for the S&P 500 because you don't make new highs off of defensive sectors. The index doesn't make a brand new high, an all-time high, because defensive sectors were leading the way. A all-time high is a very bullish movement. You're not making a really bullish movement using the most defensive sectors. So while this looks really good, I am skeptical of just how far upwards this can move. And so for now, I'm still looking for more of a chop sideways movement as long as QQQ is kind of stuck in here. As long as we're below that 485 to 490 level, I'm not going to anticipate too much upside in the S&P 500, and we're just so far away from that right now. We are almost 30 points away. Our ATR is 11.45, so almost 3 ATRs away from that. And generally, you don't get a 1 ATR move followed by another 1 ATR move followed by a 1 ATR move. You have some fluctuation in between, right? So it could take at least a week or 2 weeks before we got to a point where we are comfortable that the QQQ could move upwards. So we're just don't anticipate that we're going to be super bullish anytime soon. Now, could we turn back and reverse? Yes, we could easily pull back from here, but then we've got a bunch of support now to the downside. Same with on the S&P 500. Now, if we pull back from here, we could just go right back into that magnet area or this VWAP or the MA200. So that just means, will we get some directional movement because of the CPI report? Probably, but it's not going to be huge, or we're not going to expect it to be huge or super directional. I don't expect the CPI data to determine a new direction for the markets. So if the CPI data comes out great, we'll move upwards. But does that mean we are now bullish mode? No. If it's terrible, then we move down. Does that mean we are now bearish mode? No. It still means it's very unlikely that the CPI data is going to break us out of this sideways motion, or our opinion that we're trading sideways. It might do it for the S&P to the upside, but not for the QQQ. And then we've got the two indices that are deviating from each other, with the defensive sectors leading and the tech and discretionary sectors lagging. That's not bullish. So that would only last so long before we expected more bearishness to come back into the market. And then that would pull the S&P 500 right back into that chop sideways range, and potentially, if it dragged on long enough, downwards range. But again, based on what I said yesterday and this morning, the potential for us to chop sideways for an extended period of time is in this market. So until we get a major catalyst, we're probably going to be stuck over here. So let's take a look at our momentum levels and see if anything has changed. And we'll see if there's anything else other than CPI. I don't think so. Jobless claims are going to be, unless there's a whole bunch of continuing claims, then no one's really going to care about the jobless claims. So it's really going to be the CPI tomorrow that has any sort of catalytic power, but again, not enough, most likely, to send us in one direction or the other. So let's take a look at those momentum levels. Well, let's look at the overall market first, actually. Got 47% above their 50-day moving average, 53.57 over their 200. Okay, so we improved over yesterday. We gave ourselves a little bit of a margin of safety, so we're not in imminent danger of going bearish. So that supports going sideways. Let's look at our major indices, starting with the NASDAQ, 46.55. So again, we do have a little bit of a buffer right there. So this is more chop sideways territory. Russell 2000, same thing, chop sideways. S&P 500 still looking bullish. It still has some upside momentum to it. And when we look at our sectors, discretionary, on the very verge of being bearish. Energy, same thing. Okay, staples looking very strong and healthy. Same with financials. Same with healthcare. Industrials looking not bad. And then we are sideways, because look at the big difference between the MA50 and the MA200. So generally about 20% is normal, but we can see that all these other sectors right now, they're only about, well, this one's 0% difference, and we've got about 10% difference on most of these other ones. So in this environment, we would expect a normalization amongst the sectors. So even though normally we would consider about 20% difference between the 50 and the 200 as normal, right now the other sectors are telling us that, look, it's actually a lot more normal to be just about even. Real estate 84.87, communications 64.68, utilities 87.94. We've got healthcare 70.71. So actually, the healthy ones look like there's no difference between the 50-day and the MA200. So this, given that context, this is looking a lot less healthy. The XLK and the basic materials, actually. That's interesting. And then the energies and the discretionary. So let me write that down so I don't forget. And we've got our, because it's too many. It's basically all the sectors. I have something significant to look at. So I've got XLY, I've got XLE, XLK, XLB as not looking so healthy. Then we've got XLP, XLF, XLV. Industrials is more middle of the road. I'm going to mark that as probably sideways. And then I've got XLRE looking very good, XLC looking very good, and XLU looking very good. So that's basically, we listed every single sector here. So let's take a look at those more closely. So first I'm going to start with XLI, since it's sort of the only one that was kind of had a 10% difference. And you can see that is super choppy and volatile. It's kind of a messy chart. When you look at this, it's like, oh, that's messy. Actually, XLP looks messy as well, but at least there's a directional movement to it. You can see we had the moving average crossovers, separation, the nice rainbow, and I don't have that on XLI. See, they're all crossing all over each other. So XLI definitely more of a sideways movement. XLP looking positive. XLF, or actually XLP basically at a decision point, looking like it could break out. XLF, rainbow. Oh, not quite. The EMA 8 is a little bit below that EMA 20. Sorry, a little brain freeze right there for a second. So XLF is not looking super bullish just yet, but from a momentum level, it is looking pretty good. It looks like this is gathering. So where this is bounced off of that VWAP up into the moving averages, it is now beginning to cross over, and that is looking pretty healthy versus something like XLK, where it went through the VWAP and then went back into the VWAP, and then today had a little bit of a boost above the moving averages, but there's still that MA50 really far away hanging over it. So the XLF is looking healthier, but I wouldn't be quite ready to go into XLF yet. XLV looking very good. It is similar to XLP, where we just need that little pop to bring us up over it. XLRE, same thing as XLP. XLC, very similar to XLF. And XLU, looking very good. It does have this high hanging over it, but look at that separation between all the moving averages. This is looking very, very good. So I will be very comfortable with XLU, XLP, XLV, and XLRE. XLF and XLC look like they're ready to go. And maybe the CPI report is what pushes us over the edge for XLF and XLC. So maybe not for the entire index, but for XLF and XLC, maybe. And then that's a lot of sectors. That's a lot of sectors. So that could help us push the SPY up and over. But again, it's a bunch of defensive sectors. Well, let's look at the defense, ITA. ITA is looking pretty good also, looking similar to XLF and XLC. So this could potentially get pushed over by the CPI report as well. But again, these are all for the most part, very defensive sectors and maybe like medium risk sectors. All of our high risk sectors are not. You're looking at that. See, this is XLY downward slope and hitting a bunch of resistance. Even today, this movement upwards, all it did was get us above the EMA 8, MA 200, smack into the VWAP level. We've got the EMA 20 and the MA 150 and MA 100 or MA 90 right above us as pretty strong resistance. And then the MA 50 above that. And then we've got to get over this 189, 88 level before we could get really comfortable with XLY. So XLY just isn't looking that strong or isn't looking that healthy. I'd be far more inclined to say it looks kind of like this. Okay. That looks like the more likely scenario than this. That would be a unusual movement. This would be a normal movement. Doesn't mean that this can't happen. It's just unusual. That's not that's not the normal behavior of a market. This would be a normal behavior of a market. Or a normal behavior market might be something like this. So it wouldn't be to just break through immediately. So XLY not looking great. XLK looking basically same thing, except a little bit stronger than XLY. XLB below many of its averages. It looks kind of like sideways chop, but it's just weak. It's just sitting right there at that VWAP. And that's probably why momentum wise, it doesn't look as good as XLI. And then we have XLE. Chop sideways. I think we talked about this in the morning. We're chopping sideways across the MA 200 and we're below that VWAP. Is just not that strong of a position to be in. Yes, we broke through this downtrend, but this is more like a chopping sideways across all the averages. So this looks like it's going to consolidate for a while. Okay. So let's take a look at what we could do in terms of tail risk trade. CPI reporting tomorrow, we will probably get an initial move and we'll miss that initial move, but we can still anticipate. So what is going to react the most to the CPI report? So whatever's been most volatile, whatever's been moving in tandem with interest rates the most. Normally, we would expect maybe XLU would be part of that and XLRE, but those are looking quite good. So probably XLK, maybe XLY, and XRT. Okay, so XRT is not looking that great either. It's a little bit stronger than the tech stuff, but we're below that VWAP. We bounced off of the MA 200. We're getting squeezed in between those two. But it looks like maybe we would just go with XLK or SMH. Let me just get rid of those. So SMH looks like it could break down. We'll just go with the broader XLK. So how would we play this as a tail risk trade? We could either say, let's do a tail risk trade to the upside or a tail risk trade to the downside. Either way, doesn't matter because I'm doing something like I'm risking $100 to make $300 or $400. So either direction is fine, or I could do both and then end up saying, okay, well, if I risk $100 in either direction for the potential of making $3 or $4 or more $100, if we hit one of them, then what ends up happening is even if I lose 100% of one of them, so I lose all of the $100, then the other one will make up for $300, $400, $500. Just say it's $300. Okay, I end up making $200 instead of saying, hey, can make $300 and maybe lose $100. Of course, there's a possibility that we lose on both, but that should be low possibility. Why? Because we have a news event that should move all of the stocks in the same sector in the same direction. So we don't necessarily always have that type of a catalyst, but it is with absent a catalyst, it is possible for two stocks in the same sector to move in opposite directions. But when you have a catalyst, then that catalyst should move stocks of the same sector in the same direction, assuming it's a big enough catalyst. So I'm going to count on losing one of them and winning the other one. That's how we would play this. And so I could go into XLK and look for a strong and a weak in the tech sector. Okay, so look at this. GoDaddy looking very strong. FICO looking very strong. I don't know why FICO is a tech, but they have it listed as a tech. So I like GoDaddy quite a bit. And I like it more if it had pulled back to the EMA 8, but that's okay. Strong is good. So we say GoDaddy, maybe go long GoDaddy. I'm going to look at the chart in more detail just to make sure. But that, I mean, for the last 6 months, forget about any of that volatility last week. It just either went sideways or kept on going up. So GoDaddy is really, really strong. And let's take a look for something that looks weak. So a lot of these broke below that MA200 and recovered a little bit. Some of them were stopped at that MA200. That is a pretty good candidate, but I want to see if there's anything even weaker. See, a lot of them did this. They broke through, recovered some at a resistance level. It could easily move downwards again. But I just want something that is similar to GoDaddy on the downside if we can find it. If not, then we'll go with one of those. So like this LRCX, that was another one that fits the description. ROP, PTC, all of those fit the description. This one's even weaker, a lower low, and it only recovered not even to this EMA 20. Here we go. Nice downward sloping. Cisco, they have earnings coming up. Here we go. JBL, downward sloping, very below all of its moving averages, basically a perfect reverse rainbow, and then recovering into that EMA 8 or EMA 20. JBL is a good candidate. I'll just type that right now for now. Intel, very weak. Gap down. This is probably earnings. And then just chopped sideways or drifted very slowly downwards. So let's take a quick look at Intel. Yeah, sideways, not quite into the EMA 8 yet. This is very weak, but it could try to fill that gap before coming down. So it could go up to that EMA 20 or halfway to this gap or closer to this 28 or 29 level before coming back down. So I kind of like JBL a little bit better. Okay, so let's find a tail risk trade on JBL. So can we move down? Probably not going to count on moving it down. So the thing is, the CPI or the markets did not react that much to the PPI, and we got a really good PPI report. If we get a really good CPI report, then similarly, we can probably expect that it'll react, but not a huge amount. If we get a really poor CPI report, that could be a different story. We could go screaming lower. So JBL is the one that we're counting on if it goes screaming lower, but I want to make sure that it works for a mild move, because if it's a huge move, then it'll work far better. So a mild move might be down to 99, 90. So a big move would be down to this low or lower. A mild move might be down, what is the ATR here? 3.78. So a 1 ATR move would be a mild move. Or we could say, okay, maybe it goes down $4. So if I go $4 down to 100, we're at 104.04. So if we go down to 100, and I'm giving myself over a month of time, so I could go a little bit further out the money. It just depends, how much do I want to risk? Do I want to risk $100? Do I want, or if I want, do I take two of these or just one of these if I only want to risk $100? So let me take a look at the other one first, just to see that we can risk a similar size. So let's look at GoDaddy. GoDaddy, if we do really well, again, I'm not expecting it to move super high if we do really well. So let's just, again, just take a 1 ATR move, which would still be a pretty good move. So it looks like roughly $4 again. We're at 160. So 160. So I would have to go a little bit further out in order to just invest 100. So I could go, that's a little too wide for that price range. So if I move up $4 tomorrow, then looks like we'd only make 50%. And if I do JBL and we move up $4 tomorrow, and we did the one that is roughly $1, we would lose roughly 50%. So that'd be break even. So this is not looking like a great, either on either part, a great tail risk trade. The movement that we're looking at just isn't big enough to give us multiples. It's a 50% move is okay. It's not great, but it's just not, it's not juicy enough. So we definitely would not want to do both sides. So then we ask ourselves, would we rather be long or short? Well, we talked about how if the CPI is really great, yeah, the market will move up, but look how much GoDaddy moved up today on a really great PPI report. We moved 1% and moved 1.53, which is not even half an ATR. So, but if we move to the downside, then we have the potential for us to go outsized to the downside. So in this particular environment, if I'm looking at a tail risk trade with only a single option or a single position, then I'd rather it be to the downside. And so I'd be looking at JBL. So we're going to forget about doing a pair, and we're just going to say, okay, either we win it or we don't win it. So if I look at this and say, hey, I want to put at risk $100, but actually it's not really going to be putting the whole thing at risk, because I'm not going to lose the entire position on something that expires over a month away on a 1 ATR move. So if I go up, so this one is marked at $1.15. If we go up $4, I am priced at, just call it 55 cents, then I lose 60 cents. I lose 60 cents, which is a little over 50%. If we go down 4, I'm priced at $2, so I can make 85 cents. So my reward risk on this is 0.85 divided by 0.6, so about 150%, 1.5 to 1. Not great for a tail risk trade, but not bad for a normal trade. And again, what what if we move more than one ATR? So we don't really expect to move more than one ATR on good news, but on bad news, we could move more than one ATR. So this is an okay. I wouldn't call this a great tail risk trade, but it's the example that I came up with in front of you guys on the top of my head. So we're going to run with it because I don't have time to look for something better. So let's just go ahead and just put this in JBL. And this was the September 20th. I just want a long put. JBL September 20th, 95 put. Okay, so it looks like we can get in at, well, I called it $1.15 because we're probably not going to get $1.12.5. So we probably pay up a little bit and be $1.15. And let me just let's call it $1.15 and we'll see how that goes. And we don't have to just wait for a single day. We could wait to the end of the week. We could wait a couple of weeks, depending on how this plays out with that CPI report. But if we get a one ATR move to the downside or a one ATR move to the upside, we have a 1.5 to 1 reward risk ratio, which is okay for a normal trade. So I'm just going to go ahead and save that and call that the CPI. I don't even want to call it tail risk trade because the reward risk isn't, I'll call it quote unquote tail risk trade because it's not really, it doesn't quite really fit the definition of a tail risk, but that's as close as we're going to get off of something that I just came up with on the fly. So that's an example of how we go through the thought process that goes behind it, how you ultimately end up. So how do you go from a trade idea to planning and timing to the execution of a trade, or how you're going to implement or try to take advantage of the trade idea. And then what's left from here is trade management if the trade actually goes through. And right now our goal is, hey, we're looking for a big move off of, or a quote unquote big move, or a relatively or big move off of the CPI report. And if we don't get it, then we'll probably just close it. And then we would either make a baby amount to the upside or lose a baby amount or I said that wrong. If it goes up, then we make a baby amount. And if it goes down, then if it goes up, we lose a baby amount. And if it goes down, we would make a baby amount. But if we do get that one ATR move, then we do okay. 2 divided by 1.15, that's a 73% gain in a single day. So that's not bad. That's not bad at all. So if we don't move, then we just take the trade off. We only put $100 at risk. And so if we lose $20, $30, $40, we're not going to cry. But if we to risk $20, $30, $40 and end up making $80 to $100, that's not bad. That's not bad. So you would just size it to make it meaningful to your portfolio. If we're talking about $100,000 portfolio, then this trade you might as well not do it. You would add in the number of contracts to make it meaningful. So just say if I have a $100,000 account, then would a $1,000 move be meaningful? Well, that's 1% of my account. It could be meaningful. That might be worth my time, because if I lose, then I'm only losing a couple $100, and that's meaningless inside the context of my $100,000 portfolio. Or we could try it another way, say, okay, well, if I lose $1,000, it's not that big of a deal to my portfolio. But if I end up making $3,000 to $5,000, then that's a good amount for a single day for my portfolio to gain 3 to 5% in a single day. That's not bad. Even if it was just in a week, that's not bad at all. So you would just scale it up by the number of contracts to get it to be a meaningless movement to the downside, but a meaningful movement to the upside. So I've been talking for 40 minutes now, longer than usual. So we'll stop it right there, and I will see you guys tomorrow.